Welcome to Sadis and Goldberg's Cannabis Trends in 2020. Today I'm joined by three great guests in the cannabis sector, Marni Pankin, Bobby Leidy, and Jordan Youklis. I'm going to allow each person to introduce themselves. Marni's going to start first, who is a partner at Marcum. Welcome,
Thanks,
Marni.
Ron. Thanks for having me here today. Hello, my name is Marni Pankin, and as Ron said, I'm an audit partner at Marcum. We're one of the largest independent public accounting and advisory firms in the nation. We have offices throughout the United States, as well as China, Ireland, and Cayman. We provide a full spectrum of traditional tax, accounting, and assurance services, as well as advisory, valuation, and litigation support. And we have several niche practice areas. One of them is in the alternative investment group space, and another services clients in the cannabis industry. So we work with operators, sponsors, managers, and investors, both public and private. I personally have been working with investment managers investing in cannabis since 2015.
Great. Jordan, since you're next on the Hollywood Square box on my screen, why don't you tell us a little bit about yourself?
Perfect. Thanks, Ron, and good morning, everyone. My name is Jordan Youklis. I'm a founding partner with Key Investment Partners. Key Investment Partners is a private equity firm based in Denver, Colorado, focused exclusively on investing in the emerging cannabis industry. We have the flexibility to invest in cannabis companies that operate within both the plant touching and the ancillary side of the cannabis industry. However, our focus is predominantly today on the ancillary software, business services, biotech, and healthcare services companies that are really helping to build the industry's ecosystem. And we predominantly focus on growth investments, so later stage private investments for companies that have established themselves as clear market leaders within niche subsectors of the cannabis industry.
Wonderful. And Bobby, last but not least, please introduce yourself.
Yeah, absolutely, Ron, and thanks for having me. My name is Bobby Leidy. I'm the founding partner at Teneo Capital Management. Teneo is a cross-cap fund investing in both the public and private equities in the cannabis space, both plant touching and ancillary. By way of background, I started my career in capital markets, started investing in the cannabis space back in 2014, launched a private equity fund and ultimately raised and deployed over $150 million into the space. I've operated cannabis businesses. I've transacted on M&A. I've taken companies public in the space. So I know the industry very well, and obviously look at it as an amazing opportunity going forward. So I'm happy to be here.
Thanks for joining us. And to give anybody some background on myself, I started my career at the SEC, where I used to prosecute asset managers from the New York office. I'm one of the founders to Sadis and Goldberg, left my name off of the firm. Our firm on average organizes about 80 hedge, private equity, venture capital funds around the world in every asset class, including cannabis. We happen to be both counsel to Jordan and Bobby's firms. We do work with Marcum on the audit side for many of those funds. And personally, I've been invested in the space for probably about 5 years as well. So I have some background in it outside of just practicing law, representing funds and asset managers in the space. So the good news is this is a very challenging year with a lot of different things going on, which gives us a lot of subject matter to discuss in a very brief period of time. So first and foremost, whether it be Bobby or Jordan, I'm going to throw this out to you, but Marni, you're obviously always welcome to share your thoughts too. How has coronavirus affected the marketplace of the portfolio companies or issuers that you're seeking to invest with?
Thanks, Ron. That's a great question. I'll kick it off and then pass it over to Bobby. So coronavirus in cannabis has been pretty interesting in a multitude of ways, and I'll bifurcate it first between the consumer markets and the capital markets. So tackling the consumer markets first, in kind of a surprising way, coronavirus has actually been a tailwind for the cannabis industry in a lot of ways. And so taking a step back, when my partners and I founded Key Investment Partners, focus on the cannabis industry, one of the main reasons we liked the sector was we had a strong thesis that it would prove to be a very recession resilient industry, similar to alcohol and tobacco, right? When times are good, people want to consume. And when they're a little bit down on luck, they also want to consume. And we've seen that play out exactly, to the T during the coronavirus pandemic. Obviously, we're expecting a pandemic, but nonetheless, as people are anxious or stressed or bored, they found that turning to cannabis can be a really effective way to help with any of those, issues going on. Not to mention the fact that what we've seen in almost every single state that's legalized medical or recreational cannabis, that they've deemed it to be an essential business. So I think that's given a lot of conviction to folks and consumers in the industry that this is something that's here to stay. It's not just a short-term trend that's going to be reversed by some type of legislation. Seeing places like Illinois and Michigan that less than a year ago were fully illegal to now be deemed fully essential businesses, it's been, I think, a pretty clear line of sight that this is an industry that's going to be around to stay. And then finally, the other tailwind that we think we'll see as a result of coronavirus is a lot of state governments that were already very highly capital constrained very tax revenue constrained are even more so now as they're dealing with ramifications of the coronavirus fallout. And so we think this is going to cause a lot more regulatory incentive for more states to come online and legalize over the coming years. So from that standpoint, really, it's overall been net a positive for the cannabis industry. Obviously, some short-term shakeouts, some issues with supply chain, certain specific subsectors in cannabis have hurt it, because of it. But overall, I'd say it's been a tailwind. Now, on the capital markets side, cannabis has always been a very capital-constrained industry for a whole host of reasons, including the fact that a lot of traditional private equity and VC funds can't invest in the industry because it's considered a vice industry. Federally insured banks won't lend money to cannabis businesses, and a lot of traditional private markets investors just simply weren't yet comfortable with the federal illegality of the industry. And so what we've seen post-COVID is those dynamics have only exacerbated, right? Because in a post-pandemic world, we've seen a lot of folks who are maybe opportunistically looking at cannabis have now shifted their focus on what they deem to be less risky asset classes. And a lot of other dedicated fund managers in the cannabis industry have shifted to focus on supporting their existing portfolio companies as opposed to deploying new capital. And so those capital constraint dynamics have only really increased, and we're seeing very attractive terms and valuations, particularly relative to what we were seeing in the second half of 2018 and first half of 2019 when the industry was just red hot. So all in all, I think it's been positive developments for us as investors in the industry.
Bobby, what are some of your thoughts tied to how coronavirus has affected either your perspective on the viability of investing in the asset class, positive or negative, in what ways?
Yeah, look, I think, Jordan covered it there. I would just want to reiterate the budget deficits that exist in many of these markets. If we look at Illinois, for example, to date, since they've launched their adult use program starting January 1st of this year, they've done over $100 million of tax revenue. Last month alone, the state did $68 million in sales with $28 million of tax revenue. So that's real money that's going to these coffers, the states that really need that. I would also say that the coronavirus, as Jordan was saying, has really kind of put a spotlight on the industry, which is so important. Mm-hmm. And I think we're starting to see that from a macro perspective, see that impact, right? We're talking about a stimulus bill right now that's under negotiation to include banking reform. Ultimately, the argument there is to kind of take the cash out of the system, allow people to use their credit cards, all about kind of crushing the virus, which is extremely important. But ultimately, that also goes into the fact that the industry was deemed essential, and now giving the opportunity for the cannabis businesses, the moms and pops, as well as the larger companies, to be able to access the federal support that other, regulated industries and other normal businesses can access. So I think it's been a boon for the industry, certainly.
So other than the potential issues regarding regulations, right, and the legalization of cannabis, what are the downside risks you see that might have arisen from coronavirus, like supply chain interruptions, anything else of that sort?
Well, I could talk to that if you'd like.
I would love.
Well, first off, because, the sale of marijuana is illegal under federal law, most of these businesses were ineligible to receive the SBA loans and the PPP loans and other federal assistance, which was, not so great. One exception, though, was with hemp-related business, under the 2018 Farm Bill, that's legal, and they were able to access the SBA assistance. The other issue with respect to imports, much of the vape equipment, LED lighting, the packaging, it's produced in China. So with that country being in lockdown in Q1 2020, that definitely caused a chain reaction of issues in North America regarding consumption and production. And I'd say the biggest downer with respect to the coronavirus, I would say, is the increased concern regarding the consumption of cannabis since the onset of the pandemic. Because of the fact that it's a respiratory virus, there are concerns that the ingestion of cannabis products may heighten the effects of the virus and or limit the body's ability to recover. So there's still a lot unknown about this, but the health agencies are urging for increased caution when consuming products.
And Ron, if I could add just one thing onto that?
Yeah.
From a negative standpoint, well, I'm just to follow what Marty was saying, there is research that's starting to come out, although it's small, relative to the cannabinoids in the plant and possible impact on inflammation, and how that might kind of be a benefit to people suffering from the coronavirus. So it'd be interesting to see how that plays out. But from a negative standpoint, which I think ultimately kind of, turn itself into a potential positive when thinking about the supply chain, looking at markets like Massachusetts and Nevada, which did completely shut down their adult use programs during the coronavirus. In Nevada in particular, they continue to allow for just, delivery. So looking at some of the ancillary players in markets like that, really became valuable at that point, and became such an integral part of the supply chain, was fascinating to, kind of see that evolve.
And I think Bobby bring up a great point with regards to like states like Massachusetts and Nevada not deeming it an essential business. And one of the things I'll highlight as to why we choose to focus on ancillary investments today over plant touching businesses is typically one of the top risks we'll identify in any given deal, particularly plant touching deals, is when there's when there's regulator geographic specific risk. And so I think Massachusetts is like a perfect example of that. So Massachusetts legalized in 2016. But it took them almost 2 years to actually get recreational sales up and running. The regulators couldn't figure out how to control and enforce it. They didn't have any testing labs that were running. So if you can't test it, you can't sell it legally. And so if you're a plant touching business in Massachusetts and it took you a year plus longer than you're expecting to be able to start sales, well, that could have spelled financial ruin for you. Finally, they got their act together in 2019. Things are going great. The state's going like wildfire, and then boom, 2020 hits, and Massachusetts regulators, for whatever reason, chose to deem recreational cannabis as no longer an essential business. And what you also seen is a lot of folks who are using medical cannabis in Massachusetts no longer chose to get medical cards just because they didn't need to anymore now that rec was legal. But when rec was now deemed a non-essential business, they no longer had access to cannabis. And so that's really caused a lot of turbulence for folks in the Massachusetts markets. Now, take, for example, some of the ancillary players, like let's say point of sale software systems, right? And what you saw happen in 2018, next to Massachusetts being much slower to deploy their recreational program, was that Oklahoma came online with one of the most progressive medicinal cannabis programs in the entire country, started sales within 2 months of passing that legislation. And Oklahoma's been a huge growth market that no one really saw coming. But for these ancillary businesses that are able to cross state lines with no regulatory issues, they're able to go to, skate to where the puck is going and take advantage of these growing markets, whereas folks that were restricted to one specific market like Massachusetts may have suffered materially from that.
So that leads to, I guess, an interesting follow-on conversation or point. So elections coming in a couple of weeks. There are very strong opinions depending on which party gets elected. How are you positioning your portfolio in light of the presidential election? And then what I'm going to do is a follow-on question. We can try to address this all together. Do you anticipate, not hope, do you anticipate whether the laws might change so that it reduces that risk of I'm a grower and my ability to transport it from state to state versus the inability to create efficiencies from one state to the next? I know Marty's not running a portfolio, so the portfolio question really is tied to both Jordan and Bobby.
Yeah, I'll take a quick shot at just kind of talking about how we're positioning our public equities portfolios. So, look, no matter what the outcome of the presidential election is, ultimately, we see it as a win-win for cannabis. That the current administration and the current Senate, have been somewhat challenging as far as, passing legislation. That said, it's a testament to the industry to continue to see how the various MSOs have continued to perform, obviously in a challenging time with access to liquidity and capital markets being what they are, the cost controls and measures that they put in place to kind of, focus on profitability. I think it speaks to the true grit of the industry. That said, obviously, a shift in the Senate to a Democrat majority and a potential Biden win, a blue wave, so they call it, would be certainly very supportive for the industry. So, we're positioning ourselves as long. Obviously, we're long, cannabis at this point, although we do have the ability to go short. Our focus is on the MSOs. Trump has come out in favor of the States Act. Biden, on the other hand, in favor of decriminalization, and with Kamala Harris being a sponsor of the MORE bill, the MORE Act, both sides have kind of expressed support for the space. And so, we believe that obviously there is going to be a macro shift that happens and catalysts that take place over the coming years that are going to be very supportive for the industry. Banking in particular, if that's something that can get done now in the stimulus bill or soon after, that gives access to not only cannabis companies to bank with traditional deposit banks, national banks, but also access to their balance sheet for mortgages and, potentially the ability to uplist on the US exchanges. So we want to be long cannabis going to the election.
Jordan, what are your thoughts?
Yeah, I agree with what Bobby said. I think when we think about the election here, we really only do upside optionality in the sense that the most restrictive, quote unquote, outcome would be maintaining the status quo in terms of a Republican controlled Senate and a Trump presidency. And so if either of those flip, we think it's really only providing upside and faster pace of legalization. And in fact, of the two, we actually believe that the Senate switching over to the Democrats will probably spur legalization to occur faster than Biden over Trump, because we've seen historically that Mitch McConnell, the Republican majority leader of the Senate, has been one of the most ardent roadblocks to any legalization for cannabis at the federal level. And so taking a step back, in a situation where we still maintain the status quo, we think that there's still going to be fantastic growth opportunities. We expect that there's a high likelihood that both New Jersey and Arizona could legalize rec. Those are both huge markets in November. And then if New Jersey falls, we think that there could be a trickle-on effect of New York, Pennsylvania, and Connecticut all also being large markets as well. And so we're trying to really just target companies that are really taking advantage of those tailwinds, regardless of who's going to win the election, because we don't like to take speculative bets on regulation change. Florida, Ohio, also very attractive medicinal markets that we think will turn rec within the next few years. So targeting businesses that are really working in those geographies as well. And then the other thing I want to highlight too is, even if we do have a blue wave, as Bobby alluded to, it's not like Biden and Harris come in and boom, cannabis is legalized internationally. There's no state issues. There's no tax issues, and it's all honky-dory, right? It's going to be a very slow, deliberate process, and will likely occur in phases. We think that the first major piece of legislation that will be passed at the federal level will be something like the Safe Banking Act, which will open up financial services operators to work with state legal cannabis businesses. Then you'll likely see something like the States Act, which would reschedule cannabis from a Schedule I substance, but not completely deschedule it, meaning it would be off the Controlled Substances Act. And so in that situation, cannabis businesses would be able to operate in states that legalize it, but you still wouldn't have interstate commerce. It would clear up Section 280E of the tax code, which is this antiquated, overly punitive piece of the tax code that's really negatively impacted cannabis businesses historically. And then from there, probably I would say, even with a blue wave, likely 3 years out at least, would be something like the MORE Act getting passed, which would then open up interstate commerce. And even then, you'd still have to figure out how to regulate the industry. There still would likely be some state protectionism against letting their cannabis operators operate in other states as well. So long story short, even under the most favorable regulatory regimes, the path to legalization at the federal level is going to be at least, I'd say, a 5+ year process.
I would agree.
Okay, I wouldn't have thought 5 years. Sounds really long in the scheme of things, but I guess better to take a more conservative perspective and bake it in to your plans.
Many catalysts between that time, though, Ron.
Right.
And I think Jordan and I are thinking about legalization. We're thinking about cross-border transportation of cannabis.
Exactly.
As opposed to letting each of the states regulate and have them be their own peach tree dishes.
Correct, and ultimately access to capital markets. I mean, look, for the space to really kind of get where it needs to be, these companies need to be able to access liquidity, and that happens through the ability to kind of uplist onto U.S. exchanges, which could happen, sooner rather than later, is our hope.
Yeah.
That's
actually something I think is worth diving into a little bit more. Sorry to cut you off, Ron.
No, but don't worry.
But yeah, I think Bobby brings up a really great point right now that a lot of our listeners may not be aware of. But any company that's currently has plant touching operations in the U.S. is currently unable to list on a major exchange in the US like the NYSE or the NASDAQ. And so what that's done is it's forced a lot of these businesses to list on what's called the Canadian Securities Exchange. It's a pretty thinly traded, illiquid exchange up in Canada that will allow cannabis businesses, but the governance requirements are much lower. I think just the liquidity in the market's a lot lower. And so a lot of ETFs and institutional investors that would typically be able to purchase these types of businesses based on their underlying growth trends and the market cap of businesses, like the large MSOs, haven't been able to access those businesses yet. And so with legalization occurring and then being able to uplist to a major exchange, we think that'll be a huge boom for the capital markets environment in cannabis.
And if I could just point out, I think that major tax reform is going to be necessary for the ultimate success of this industry. I mean, 280E dramatically impacts the ultimate net profits generated by the cannabis companies. By prohibiting those business expense deductions like salaries and utilities and marketing and advertising and insurance for businesses that touch the plant, the government's actually imposing an effective tax rate that's like about 2 to 3 times higher than traditional businesses. And I wanted to mention a US tax court case that was decided last year. It's a company based in LA called Alternative Healthcare. They tried to avoid 280E by setting up a management company, which is common practice. The management company was called Wellness. So Wellness's responsibilities were hiring and paying the employees, handling the advertising, dealing with customers, and other responsibilities that didn't include growing, producing, or actually selling the product. So they argued in court that they were not subject to the tax laws of 280E, and they should be able to deduct all these expenses. But their argument was lost in court, and this has been a blow for companies that have considered similar arrangements. So even with the change in administration, with this move towards decriminalizing cannabis, doing this without legalizing it and taking it away from being Schedule 1 and still being it subject to 280E, it's going to have a negative impact on the legal industry because it'll be a lot cheaper and a lot less risky to get your pot and your edibles from the black market.
So let me do a follow-up question, Marni. And I have 2 questions. I feel like playing old school with you saying I have 1 question in 32 parts, but I only have 2 questions. So the first question, wait to hear both of them, please. So does that case, result of that case mean the bifurcation of business structuring between plant touching and non-plant touching is at risk for companies in the space? And then 2, what, if at all, reform is being discussed that you're familiar with regarding 280E?
Well, I think you need to be very careful when you bifurcate your business. So in this instance, even though there actually weren't touching, this was really in and itself the same business. The employees were, still doing work, with the plant touching activities. So bifurcating, you have to be very strategic about it. And, you probably need to still allocate certain expenses to, the plant touching that in fact will not be tax deductible.
So the short of it is just be smart about it. It's still viable and don't be too greedy.
There you go.
And then what about reform? Sorry, I was just simplifying for those people who might be using the product listening right now.
So I currently am not aware of any tax reform, but it is important to have proactive tax planning during the M&A process. That will definitely minimize your tax burden and maximize the deal value. So what I'm saying here is that, based on how you structure your acquisition, there's different tax implications to consider. So if you're, basing your, you're doing an asset acquisition versus stock acquisition, you're going to have different tax applications. If you're structuring as a reorganization, it's certain portions of it may be non-taxable. If you're actually getting stock instead of cash, that part would probably be non-taxable. Also, when talking about debt, when you're restructuring debt and you're dealing with consent fees for the restructuring, you should, consider setting it up that it would be more like an installment sale reporting as opposed to, a fee, which would be ordinary income. So you just have to be smart. But in terms of new tax reform out there, I'm unaware of any new stuff on the horizon.
Switching gears a little. Yeah, go ahead, Bobby.
Sorry, just have
Jordan.
one on that. Yeah, no worries. Marni, I think that's a great point, and it gets a little bit to kind of just the broader issue within the cannabis industry of the stigma around it, the whole headline risk of it, right? And so one of the reasons I think that there hasn't been any real progress on just tax reform to do something that would clean up Section 280E is because for any politicians to come out and say, we want to fix Section 280E and reduce the overall tax burden on cannabis, right? That's a very difficult sell to the public who only reads the headline, who isn't in the weeds and really understands what this means. They're going to say, well, I thought the whole point of legalizing cannabis was to generate tax revenues and help our state. How could you ever come out and say this when they don't understand the intricacies of what 280E actually does and why it's so overly punitive to these cannabis businesses? So that's why I think for that to get cleared up, it's going to need to be a part of bigger legislation like the States Act that would reschedule cannabis from being a Schedule I substance, and that then the trickle-down effect of that is that it's no longer subject to Section 280E.
And there's a really good points, Jordan, about the social stigma regarding cannabis. But based on polls that have been taken over the last, I guess, 24 months, it seems that the stigma has decreased dramatically relative to where it was 10 and 20 years ago, in that it's become more socially acceptable. There are many references that in the same breath will link it to alcohol consumption. And I know alcohol consumption recently has an uptick of about 20% in the marketplace than it had prior to coronavirus. So yeah, it's probably a matter of time for this to change, but we've already seen a sea of change occur over the last several years.
Can I just add to the 280 conversation, Ron? So I think it was Marni that made a really great point. Marni, I mean, it's extremely punitive, 280E. I mean, in the end, when you factor that in, what would you say the tax rate that these companies are paying is? I've seen numbers around like 70%. Do you agree? I mean, and that, I think, then,
2 to 3 times, as much. Because
right.
think
So
about the only thing that could be deducted is the, cost of goods sold.
Right.
And I've seen cases too where they push a lot of these expenses, these indirect expenses, into the cost of goods sold number, and you have to be careful doing that as well.
Right. So I guess my point is, by eliminating 280E, yeah, there's a conversation that has to take place around educating people relative to what 280E is, and it's not really a generator of tax revenue. That said, I think it really is a way for us to for the cannabis industry to combat the black market. Right, because ultimately, I think that's gonna, that will dictate prices, and if these companies, they're doing well today, but if 280 were to go away, I think that's, you're looking at basically $100 billion black market in North America right now. Last year, the industry did approximately 16 billion regulated. So there's a huge opportunity here with just converting people from the black market to the regulated channel. So by removing 280E, I think that gives the operators the ability to actually start to really target the black market.
Yeah, but from an argument perspective, one can also, I think the stronger argument, if we're trying to appeal to the general or broader population, isn't the tax dollars generated. It is the black market, and the fact that there's a crime associated with the black market, and there's extra expense of your and my dollars to the police force on how they're allocating their time tied to the black market, which would be under pressure if the laws were to change regarding
Absolutely.
the non-black market.
Yep.
So Jordan, I completely agree with you. It takes some political capital at risk to broach the subject, but I think the message can be clear. And you're right, it is incumbent upon all of us who have some role in the industry to bring a positive message about it. It's not just about getting stoned per se. And that's where the negative connotations come from. Flipping from portfolio construction and trying to guess where we think the future is going, let's talk about your practical business management as well. For those people that are in the audience who either may be running a fund or may want to run a fund, why don't the two of you share with us some of the bigger challenges you faced, and hopefully it wasn't response time from your law firm. That might give insight to people. And then Marni and I can give you some background on some of the issues we see for those people who may not have organized their thoughts as clearly as the two of you have.
Sure.
So what were the bigger hurdles?
Yeah, I'll take a shot. So look, I had already been in this space, investing in the space for 5 years before I launched my fund, 6 years actually. So it really wasn't that challenging for me to get over the hurdle of, do I want to have exposure to the space? You know, I was already there, so I felt good about that. Identifying, you know, what part of the value chain I wanted to position myself in and where I saw opportunity, that was a big decision that I first had to make, and I geared that more towards the public equities at this time. You know, and kind of formalizing what my thought process was around the structure of my fund. The biggest challenge I had was ultimately vetting and finding the service providers that were then going to go on and work with me going forward. So obviously very fortunate to come across you and Sadis. And then ultimately opted for Marcum as a tax and audit, and Opus for fund administration, all wonderful service providers. But getting through that, then getting through the documentation phase, the fund formation, you know, that just took time. It just took time, and it was a heavy lift. But once you kind of made that commitment to move forward as a business owner, it makes that, you know, all the much more, you know, kind of an easy process.
How about you, Jordan?
Yeah, so I think that, you know, one, because we were able to find you, Ron, and then you put us in touch with some great service providers as well, that was really beneficial. But yeah, I mean, I think Bobby's spot on in terms of just what you find in cannabis is everything is harder and costs more and takes longer to figure out. There's ways to do it, and you might have to create the way yourself, but just expect to run into hurdles at every possible turn and every avenue. The other thing that I'd mentioned with regards to one of the biggest concerns with funds in cannabis is also one of the biggest advantages to being a fund manager in cannabis, right? And it's the capital markets environment, right? As I kind of alluded to earlier on the call, having it's a larger pool of institutional capital to invest in cannabis really is a huge differentiator, because there's just not many players in the industry actively deploying capital into cannabis today because of the whole host of issues we've talked about earlier. But that is a bit of a double-edged sword in terms of us finding limited partners. It's not like we're raising a traditional private equity fund and we can go get a $100 million anchor from CalPERS and then tack on 10 other pension plans and banks around the country, right? Effectively, all traditional institutional investors have completely refused to put money behind cannabis fund managers, endowments, foundations, banks, pension plans. They won't touch the asset class at all. And so you're really reliant on finding the high net worth individuals, the family offices, and the wealth managers that are really willing to back the cannabis industry at an early phase. And so it can be just a more difficult sales process. Turning over the stones to find those investors is a little bit trickier than just being able to look up the public pension plans that are out there deploying into private equity today. But like I said, that's also exactly why such a great opportunity exists for fund managers in the space.
I mean, it's interesting that you mentioned that, because I've had several clients, I'm not talking about one or two, but several clients that they're like, all right, I'm going to test the waters with, 3C1 fund. And before you know it, all 100 spots are slotted in. So after the fact, they open up their 3C7 fund, they're going to be parallel funds. But at that point, you're dealing with the administration of transferring over your high net worth that were originally in the 3C1 into the 3C7, dealing with capital calls that already happened, transferring interest between one fund to another fund. Also, you've already been investing in the first fund, so now you have to break out the investments into the two funds. So administratively, it's a bit of a nightmare, especially if you do it over a 2-year period. So what I would recommend is go for the parallel fund structure right off the bat, or at least have a really good sense of who your investors are going to be.
I mean, for those people in the audience, references who may not be familiar, references to 3C1 and 3C7 are sections under the Investment Company Act that exempt you from having to register as an investment company. And specifically, one is for high net worth persons, and the other one is deemed for more institutional. And the one that's more institutional allows for a larger number of slots of investors you're able to accept. Both products are limited in the number of investors they can accept, so that it balances out with the regulatory framework that the SEC has intended. Some of the other issues, sorry, Marni.
Oh, I'm sorry. I just wanted to mention with the 3C1 fund, you can have up to 35 non-accredited investors. So that's where, some of your friends and family may go in, but there is a limit of 100 spots. With the 3C7, it has to be the accredited investors, but there is, the limit is, very, very large. It was even made larger now. I think it's like 5,000.
For those managers looking to accept money from sophisticated persons who are not accredited investors, and Marni is right under Regulation D of the Securities Act of 1933, you're allowed up to 35 sophisticated persons. There are other laws that would require you, based on our read, to provide sufficient information equivalent of a public offering to take money from those sophisticated persons, which thereby makes it not practicable from an economic cost-benefit analysis. But some of the other things that we've seen that if you're launching a fund, you should be attentive to. And I don't think, Bobby or Jordan, that you experience this, but I've seen it with other people where they've come to us with certain service providers in tow. And I've explained, well, this administrator really doesn't do cannabis. People we do business with that are there, they've explained to me it's outside their policy. They will stick with the service provider. We'll get to the 1 yard line. We're ready to launch, and that firm has backed away, leaving the manager in the lurch, seeking to replace that firm. It was in one case administrator, in another case an auditor, and it created problems, and it caused one of the firms to incur materially more organizational expenses to launch. The other component that we see that can be a challenge, and Bobby, you and I had the conversation early on when we were structuring your fund, was what percentage of your portfolio do you see that's going to be liquid versus illiquid? Because Jordan running a closed-end fund and Bobby running an open-end fund, how they take money in is different. How they value their portfolio is different. And that can add challenges because we're trying to have you nail down your portfolio structure today or construction today, and the world's dynamic and changing. And so we do our best job, and we walk our clients through to explain to them the pros and cons of each decision. And then the third thing that we're seeing as an issue is for managers accepting money from non-US persons. And if they want to launch a dedicated non-US domiciled fund, the traditional jurisdictions that we use for offshore private equity, venture capital, or hedge funds are not viable at this time in history. Cayman Islands, BVI, Bermuda. If it's illegal in the United States or federal law, then it's a violation of their local laws. And so that can cause a whole range of issues as well. We found one or two jurisdictions that work from a legality perspective, but from a commercial perspective, they don't really get the respect that they may or may not deserve, so to speak, or have the volume or number of funds similar to Cayman, Bermuda, BVI. So Marni, I don't know if you've seen any of those issues.
Yeah, I mean, what happened, typically I haven't been really dealing with offshore funds in the cannabis space because of those reasons. So foreign investors will come into domestic entities, and there's a whole issue with withholding taxes and potential what we used to call FIN 48 tax liabilities, unrecorded tax liabilities that can be and probably need to be accrued on the books. So just other tax implications come into play when having offshore investors in your domestic funds.
I have not heard FIN 48 mentioned in about 8 years. So FIN 48 is like the long arm of the tax authorities of other jurisdictions. That if you're running an offshore fund, you might have a tax liability in Belgium or France or Germany. And what happens is if they're deemed to be material, your auditor might result in wanting to give you a qualified opinion or require that you get FIN 48 insurance. Marni's shaking her head no, so did I not get it right?
Yeah, I think that FIN 48 insurance came and went. But with respect to tax liabilities, I'm kind of talking more with respect to when you're doing a lot of the deals out there and it's questionable what the tax rules would be, and if you take a tax position, the tax position that you take for the taxing authorities has a lower threshold of it being sustained than for the financial statement accruals. So therefore you may have to have these accruals in. Now they're really not supposed to be tax liabilities to the fund per se, but rather should be deductions to the offshore investor's capital. But if they don't get recorded, and if that offshore investor, say, leaves the fund, it will be a tax liability to the fund.
Yeah, the fund is on the hook unless they can get it from the investor left, and usually when investors leave, they're generally not really interested in giving money back. That's been my experience. So going back to the portfolio, so why now? Why invest now? Why not wait till 2 months from now, 6 months from now, or sit it out like some of the institutional investors might be doing until it becomes federally legal?
Go ahead, Bobby.
Okay, I'll take a quick shot, Jordan. I'm sure we'll probably be able to ham and egg quite a bit off of this one. Look, our view is that this is really the most opportunistic time to get in because of those challenges and those constraints that exist in the market today. The fact that there is this wall of pent-up demand from institutional investors looking to get into the space, but they're holding back, right? All those roadblocks and barriers that exist, the regulatory environment, the state by state. The state issues, the cross-border transportation, the fact that this industry is still so nascent, but is growing every single day. But giving this kind of like amazing opportunity for investors to come in at a period of time where, quite honestly, companies have really had to de-risk themselves and make themselves really focus on profitability. So if you're looking at private investments or investing in operating companies, there's tremendous opportunity in buying assets today that were valued much higher not long ago. From a public equity standpoint, obviously, I'm looking at investing into companies and owning stocks in companies that are trading at significant discounts to where they were just 12 or 18 months ago. So the view here is that, we're trying to kind of stay ahead of this curve, kind of catch this kind of upward trend, this upward momentum that we see, both from a macro perspective, from the various catalysts we've discussed, all the way down to the improving fundamentals, especially here in the United States, as new markets open up and as these companies become more profitable. Our belief is that it really is a tremendous time to be allocating capital today.
Yeah, completely agree with everything Bobby says. I think it's if you look at all the regulatory momentum, the number of states that have come online, the number of bills that have been put in front of Congress, the popular support, which Ron alluded to, where now over 90% of Americans are in favor of medical cannabis legalization and about 2/3 are in favor of recreational cannabis legalization. I mean, the writing's on the wall, right? We truly believe it's now not a question of if it's going to be legalized federally, it's a question of when it's going to be legalized federally. But the benefit of getting in today is because it's not yet federally legal and you have to deal with all these issues that Bobby mentioned, you're able to get into companies at much more attractive valuations and terms than you will be after legalization is made at the federal level. And I think a great example is just after the VP debate, when Kamala Harris said that they would decriminalize cannabis and reschedule it, that most public cannabis stocks all jumped 15 to 20%, right? I mean, it's obvious. This has been part of their platform, but it's just people don't recognize it. It hasn't been on the radar. These institutional investors still can't access cannabis investments. So your ability to get in at a very attractive point in time is today. And I think a lot of people that maybe saw the writing on the wall, but got a little burnt, are the folks who got in when the market was red hot back at the end of 2018 and beginning of 2019. And if you look at what happened with cannabis in that time period and you compare it to what was happening with tech stocks back before the dot-com boom, the progress tracks very similarly, right? And so I think people flooded the market, got into bad stocks because they didn't know what they were doing, and there were so few publicly traded companies available that when earnings came through and they didn't produce the results that were expected, that you saw this huge sell-off. And now we truly believe that you're at the trough of the cannabis industry, and that's really only going to recover going forward as more and more states legalize and more progress is made at the federal level.
So when you guys are looking at, go ahead, Bobby, I didn't mean to.
The industry is growing at a 30% CAGR. That's just what's happening today, right? And so you've got this scenario, if you look at just the delta between the MSOs and the LPs, the Canadian licensed producers, and how they trade. You've got Canada, which is, I would venture to say, is a commoditized market. It's the pricing is becoming compressed. It's kind of for lack of a better term, it's a race to the bottom right now. Yet they trade at a significant premium from a multiple standpoint, looking at EBITDA on a 2021 and 2022 basis to the MSOs, primarily because they're able to list and trade on the U.S. exchanges. So again, we do have LP exposure in our portfolio. We like the liquidity there, but we do see this tremendous opportunity in the U.S. right now to get in prior to that kind of multiple expansion that we expect will take place.
So when you're looking at a private company, how do you determine, other than cash on hand, what companies have the staying power to withstand this time in history where 280Es against them, the cost of capital is higher, the ability to list in the US is not available, and the laws currently may take 5 years or longer to sway in their favor?
I mean, from my perspective, you know, the looking at a private, you know, the first thing I'm going to look at is the market that they operate in, right? Going back to what Jordan and I were saying earlier, you know, I agree, 5+ years, you know, is probably a legitimate time frame before, you know, we might see cross-border transportation. And at that point, it's probably about, look, building a house of brands, right? No, I would venture to say no real brand exists in the space today. But you know, that's where the industry will ultimately go. Today, looking at limited license states, where companies can actually build infrastructure, get product into the market, and be able to charge a significant premium to what it costs to produce that product. And especially if they're there prior to that state flipping from medical to adult use, where there's typically a massive supply-demand imbalance that exists. In a limited license state, that scenario might exist for quite some time. You know, so looking at the market first and foremost and how they operate is key. You know, my background, fortunately, having, you know, built infrastructure and managed teams in cannabis, I understand, you know, what it takes to build one of these businesses, and going into a facility and getting understanding of how efficiently they run. That's also critical. But the first thing for us to look at is obviously the market that they operate in.
Yeah, that's totally agree with that, Bobby. And then thinking about more like just on the ancillary side of the industry, and Ron, it's a fantastic question. I'd say is probably the number one risk we identify with any business we look at is what is this company's real long-term competitive differentiation, and as someone from outside of cannabis at some point going to be able to come in and totally eat their lunch. And so I'd say that the couple of things we focus on is number one, you have to be backing an A+ management team first and foremost, because I think the only certainty within the cannabis industry is that it's going to be changed. It's going to change. It's going to be volatile. You need to have a team in place that you trust can ride those waves, adapt, and pivot quickly to make sure they're still riding the upwards of the industry. Outside of that, finding companies that have really established themselves as market leaders within subsectors of cannabis, where we think that rather than a traditional player coming in and just eating their lunch at some point, that this business will be able to take enough market share and really establish themselves as the leaders of cannabis in that subsector, whereas those traditional players are going to be much more likely to acquire our portfolio companies as opposed to try and go and beat them from all of their customers one by one. And then the final thing I'd highlight is in the ancillary side of the industry, we really focus on subsectors where we believe there's going to be a long-term mission critical need for that subsector following the repeal of prohibition, right? And so one example I'll talk about is we've looked at a number of financial services and fintech companies because people, as I'm sure everyone knows, there's a whole host of issues related to not being able to, you know, having to use cash transactions, traditional payment processors not being able to get into the space. And that's all true. And there are lots of companies that are doing a great job of solving those issues. However, our view is a lot of those issues are short-term problems that are going to be resolved with the passage of the SAFE Banking and when federal legalization occurs. And so at that point, what is the viability of this business model long-term? It's very difficult to say. So we prefer to focus on the subsectors that we know there's going to be long-term needs, the compliance businesses, the data analytics, loyalty software, that sort of thing, where we know it's going to be a systemic need following the repeal of prohibition.
So following through on Jordan's comment about quality management teams, I'm going to turn to Marni. Marni, you highlighted notes to me that SPAC IPOs raised more than $2.6 billion last year, more than $700 million in the first half of this year. So and I know Marcum has an involvement in the SPAC industry. Are you still seeing more SPACs slated to be launched in the cannabis sector? Pros, cons, strengths, weaknesses? What are your thoughts?
Yeah, thanks. So,
Why don't you shed some light on this?
Yeah, I mean, you know, as you mentioned, Ron, in our firm, we've seen a huge uptick in the use of SPACs for emerging companies. And the cannabis and the hemp space are no exception to that. So a SPAC, and it's called a special purpose acquisition vehicle, for those who don't know. It's also known as a blank check company. It's a shell company, and it's formed by a sponsor in order to raise capital through an IPO to acquire an existing target company or a collection of companies through a merger, a capital stock exchange, an acquisition, a purchase, a reorg, or a business combination. So what happens is the public company becomes the private company becomes the publicly traded company. During the IPO, though, the target company can't be identified. So investors are going to come in just based on the basis of the founder's reputation and the sector that they're going to go in. So an example, one of the ones that our firm just worked with is Collective Growth Corp. We helped them with their S1 registration statement, and they're a $150 million SPAC offering by Bruce Linton, the former CEO of Cannabis Growth, good reputation. So in their offering, they're stating that their initial intention is to focus their search on businesses that are federally legal. So they're going to go with, servicing or operating adjacently or ancillary to the cannabis industry. So they do not touch the plan. So in their case, they can trade on NASDAQ or the New York Stock Exchange. They actually do trade on NASDAQ. If they touch the plant, though, they wouldn't go that route. They would go for, one of the Canadian stock exchanges. And these, the SPACs, I think that they're just a great way for private cannabis operators to obtain liquidity, considering the current cash crunch, and also get management expertise to help them strategically grow the business. And the IPO process is generally faster for SPACs compared to the traditional IPOs due to the simplified documentation and the listing procedures. Right now, there are several SPACs out there in the space. So there could be some healthy competition for target companies. The thing with the SPAC, though, you have to, you only have a limited time that you can actually look for a target company. It's about 18 to 24 months. So during that time, if a target is identified, you'll have to return the money back to the investors. The other thing that I wanted to mention is with respect to the target company needs to have financial statements in order to do the SPAC. So they're going to need at least 2 years of balance sheets and 3 years of P&L. They need to be audited by a PCAOB auditor. Also, the company has to have adequate finance and accounting systems and control in place before they go public. So this, is usually a bit of an issue because a lot of these private companies are not getting their financial statements audited, or they're not using a PCAOB auditor. So something to consider. Obviously, it could be done after the fact, but then you're rushing to get this done. The other important thing is just to understand, what you're giving up. You're obviously going to give up control. You're going to give up board seats. And it's important that you understand and you're concerned about the
portfolio company that would be acquired by the SPAC, right?
I'm sorry?
Talking about the portfolio
yes,
company.
Of course. Yes, I'm talking about the private portfolio company. Yeah.
Okay.
Yeah. So the target company is the private portfolio company. The other thing is you have to be, concerned with the reputation of the sponsor, because the sponsor and the underwriter, they're going to be the ones that are going to drive investor interest in here. Also, you're hoping that they're working with investors that are long-term investors. If they're short-term investors and they're going to, dump the stock right away, that's not going to be helpful for the strategic growth of the company.
We're limited on time. If there's any other subject that any of you want to raise or discuss, I'm happy to cede control of the microphone to any one of the three of you.
I just wanted to mention a little bit about valuation because it's kind of important. Year end is coming up with private equity investments. So, valuation of private and the less liquid cannabis investments, it's definitely going to be challenging this year in light of COVID. We always recommend that our clients use multiple valuation approaches when, trying to value at a quarter end or a year end. But, some of the methods that are generally acceptable are not appropriate for this industry, especially with the current environment. So when you're dealing with like a market approach, there's, major limitations when it comes to cannabis. The guideline companies may not be comparable. The public transaction data is limited, especially this year. The transactions are down significantly this year. And using the prior year transactions and the trailing multiples of the public companies may no longer be a good indicator to value the subject company, because prior period exponential growth and the speculation likely skew those valuations. And on the flip side, looking at the forward multiples may pose challenges, if these public companies are withdrawing their earnings. So there may not be as many comparables out there. Also, of course, most of these cannabis companies have negative EBITDA. So then you're going to have to deal with revenue multiples multiples, and they're definitely less comparable. With the venture capital and the pre-revenue companies, you typically value using a recent round of financing, but now, there's haven't been as many rounds. So the latest round that you have may be outdated, may be stale, and also the deals may not be at arm's length. They may be done strategically, they may be done, with related parties, so they may not be a good indicator of fair value. They also may be a different class. So, what we recommend to our clients is, make sure that you're, when you're valuing, you're looking at the different rights and the different preferences. And it's probably makes sense to use an option pricing model, because that will consider the different attributes of the, each class of stock and what's unique. So really it comes down to an income approach like a DCF, which probably will give you the most reasonable valuation. But again, the major issue there is the projections. These startup companies with the shorter histories, it's hard to judge their performance. So they're inherently subject to uncertainty and inaccuracy in their projections. And now the mature businesses, the historical results may no longer be a good indicator and a good starting point, to gauge the projections if they were severely impacted by COVID. And of course, we know that the discount rates are highly subjective. There's wide ranges, there's company risk premiums as well as industry premiums. So, we recommend that you consider various probabilities to the future events and various future cash flow scenarios. So using like a Monte Carlo simulation can model that out for you, these, different types of situations. So the last thing, though, to mention is the cost of the asset approach. And typically, this does not get much consideration. But, when you're dealing with financially distressed companies and the increased uncertainty of continuing as a going concern, this approach may be appropriate. It looks at the value of the tangible assets held by the company. So in that case, the valuation consider the inventory and how it's valued. Is it valued at historical or replacement costs? And is there obsolescence in the inventory, which would reduce the valuation? So valuation is definitely going to pose challenges come this year end. And I recommend that everyone just take, some time to really establish robust valuation policies. And if necessary, work with an independent valuation specialist to help you with those valuations.
Excellent, Marni. I appreciate the insight on valuations.
I'd like to add something before we drop off, if that's all right.
Sure.
So we've discussed the challenges that exist today, for cannabis companies themselves. We've discussed challenges that might exist for new funds that are trying to get into this space. But one thing I would like to kind of highlight are the challenges that investors face when trying to get access to the industry. As Jordan was saying earlier, there are many brokerage firms that have just basically said no, right? Especially U.S. cannabis companies that are trading on the OTC or the CSE, they're penny stocks. A lot of them right now, you can't buy them. So there are real challenges in actually executing and getting exposure to the space. I believe without a doubt that there's massive growth potential in cannabis. I think it provides uncorrelated, diversified returns for investors, and it will going forward. And so it's certainly something that I believe everybody should have as part of their allocation. It's just how do you get access to it? And the other issue that I think investors face is, for the most part right now, most investors are potentially uneducated when it comes to cannabis. You turn on CNBC, and if Tim Seymour's on talking about cannabis, he might be talking about the U.S. cannabis opportunity, but on the screen, you're going to get a list of the top 5 Canadian LPs. They're not actually showing you which MSOs are the ones that you want to buy. And even if you do know which MSOs are the ones that are the bigger MSOs that you want to buy with less volatility, you're not really adding value, or adding alpha, like some of the broader approaches, like these new ETFs that are launching. They're not really getting the alpha of knowing where to go on the tier 2 and tier 3 operators. To some extent, I would say, hey, look, from thinking about portfolio construction standpoint, you want to have exposure to the bigger names. You want to have that liquidity. But you also want to have exposure to some of the less loved names, right? So maybe the ones that have even been encumbered or have impaired balance sheets. If you think about what's happening with safe banking and banking reform, those companies might be able to refinance out of very punitive debt and get access to traditional financing. So that in thinking about the return profiles, some of those names might have, there might be significant multiples attached to them on the upside, where some of the larger names, you certainly see price appreciation there as well. So, finding the right manager that really understands the space, either from a VC standpoint, a PE, or public equity standpoint, I think is critical, and educating yourself is key.
All good points. You all have left me and the audience with much to think about. I want to thank Marni and Bobby and Jordan for joining us today. Thank you so much. Everybody at Sadis and Goldberg appreciates your investment in this time.